So, yeah, I was asked to fill in a 25-minute one this month, and I thought, well, the best thing I think I can do is really give you a complete introduction to property finance and really bring it back to the basics. Because I remember when I first started out in property finance, and there was so much jargon thrown at me, and it was assumed that I knew what this jargon meant. And it was assumed I knew this and I knew that. And I can only imagine that there's many in this room that hears all this time and thinks, how do I act? I haven't got a clue what this person is talking about, but I need to pretend that I understand completely. So I thought I'd bring it back, and I thought, let's just go right back to the beginning. First of all, I just let you know, I'm from Hilltop Capital. We are an institutional real estate lender, as well as a manager and advisor. What does that mean? We're basically a broker and a lender at the same time. Traditionally, we are development lenders. So we've done many large sort of ground up schemes, funding sort of 5 million and upwards, typically 10, 15, 20 million schemes. But back end of last year, I was asked to come on board to head up the bridging side of the business. And this is where my experience is. And we do a bit of our own lending, but we're also open to the full market in terms of bridging facilities as well. And we do a bit of buy-to-let to help you there. I'll explain a bit more about the buy-to-let options later. So start with the types of mortgage that there are. Most of you will probably own your own home. So you've got what is a regulated residential mortgage. Most of you looking, if not already, have a buy-to-let mortgage and understand what that is. CBTL, consumer buy-to-let. So that's in case you might become an accidental landlord. If you understand what that is quite simply where you may have inherited a property and you think, well, instead of just selling that property, I'm going to let it out. Because that was potentially owned by your family member, that comes under different rules and you're considered a consumer buy-to-let. Commercial mortgages, commercial properties, we'll step through the different types of commercial property, but they range from your retail shop to your warehouses and all sorts. Bridging, that's my specialist area there. Bridging short-term loans, they can be regulated, they can be unregulated. As I mentioned, regulation, it comes into effect if it's dealing with your own personal residence. If it's a purely business situation, then it's an unregulated situation. And development finance, this is typically meant for ground up schemes. However, there is a bit of a crossover with bridging because bridging can be used for large scale conversions or your smaller ones. The residential property, houses, flats, commercial, as I've mentioned, retail, office, industrial, land. Land can be purchased. That could be with or without planning. There's a huge difference there. A lot of people have businesses which quite simply buys up land without planning, gets the planning, sells it on at a huge uplift. HMOs, houses of multiple occupation. This could be your student let. It could be just a house that you're renting out to NHS staff or whoever. Multi-unit freehold blocks. So this is typically a block of flats, but they haven't actually been individually split onto titles, and it's all still owned under the one freehold property. Hotels, holiday lets, a lot of people getting into that now, and particularly with rent-to-rent schemes, renting a property and then renting it out on shorter-term lets. And now we'll get on to some more jargon, as I mentioned. There's a lot of stuff. I'm going to try and get through this quickly because I know I went through this once before and ran out of time at the end. SPV, you'll hear this particularly when you are buying a buy-to-let property. This is a specialist purchase vehicle. It's basically the limited company that you set up purely for your buy-to-let business. That's considered to be called a specialist purchase vehicle as opposed to a limited company that you might be trading out of, doing your regular day-to-day business and trying to buy buy-to-let property into that. It is much better to set up an SPV if you are doing this. HMO, we mentioned, house of multiple occupation, don't need to go over that, and MUFB, multi-unit freehold block. PBSA, in particular, in terms of HMOs, these are purpose-built student accommodations, and they have different rules around them in different situations as opposed to a simple HMO. LTV, mentioned the loan to value before, it's basically the ratio, how much your mortgage is compared to what your value is of your property. Interest only or capital repayment. Your traditional home mortgage will be quite often on a repayment basis, particularly as endowments died a death many years ago. And that is where the capital is being repaid at the same time as the interest, so it reduces the balance. Interest only will typically be your buy-to-let mortgage that you're taking. You're not really bothered about reducing the balance on those because you want to gear up as much as possible all the time because cash is king. ICR, DSCR, interest cover ratio, debt service cover ratio. These are very important with your buy-to-let situations because I was talking earlier about a situation where, because of the increase in interest rates, if you had a 75% mortgage, all of a sudden you came to the end of your term and you tried to refinance that mortgage, it no longer worked on these because the interest that you're trying to service is no longer covered sufficiently by the rental, and you could be stuck with that mortgage. Fortunately, rents are starting to come up and the interest rates are starting to come down, so it's worked out okay now. But there was a period where if you're a year or two ago, if your mortgage ended, you were in a bit of a pickle. GDV, gross development value. So that's if you're doing a refurb or a conversion, that is the value at the end once you've completed all of the works. It's the gross development value. There is a net development value which takes off things like your selling costs and things like that, which you all have at the back end. BMV, below market value. In the bridging world, we love these. We love finding a way to help you buy that below market value property based on the value rather than what you're paying for it. And in that situation, you can sometimes gear up very, very close or not, sometimes even the purchase price itself, meaning you're putting no deposit down whatsoever. BMV, if you ever hear that, that's below market value transaction. So I'll give you an example of a buy-to-let. Just through these figures completely randomly. Property value of 250. You've got a £12,000 rent, £1,000 a month. Not particularly high yield there at 4.8%. And you've got a mortgage sitting there at 185,000. I forgot whether I did that. Is it 75%? I'm trying to work out where it is. Interest rate of 5%. Your loan to value is just shy of 75%. I must have rounded it off there. And the ICR, the interest cover ratio, is 1.3 in this situation. It's pretty tight, as you can see. If you're doing this via a limited company purchase, the minimum that a lender will typically need is 1.25 cover. So you can see how it could have been very tight if when the interest rates went up and the rents weren't there. If it's an HMO or you're a portfolio landlord, that is typically 1.45, not 1.25. So it wouldn't work in that situation. Bridging finance. I always say bridging finance is when you cannot get a mortgage yet. Something needs to change before you can get a mortgage on it. That could be you need to refurbish it. You need a new kitchen, new bathroom, and so on. Could be you're converting it. You can't get a mortgage until it's converted. There's lots of reasons why you can't get a mortgage yet. You need a bridge in between. And here's the first example I've got, is a chain break. This is where you're buying before you're selling. This is, again, typically in a regulated situation. You may have found that dream property that you want to retire to in the country, but you've got a property in the city that's going to be tough to sell very, very quickly. And if you don't appear as a cash buyer, you're going to lose out on that dream property. What bridging allows you to do is buy that before you've actually sold your current one. There will be a period where you own both of them while you're trying to sell the one that you're living in at this moment. But that probably accounts for the biggest chunk of bridging business out there. And it's a regulated situation. What we commonly will look at in this room is your refurbishment situation. Buying property, doing it up, adding value, converting it, doing something like that before you sell or put it into your portfolio. It needs converting. It might need planning. We do a lot of situations where we're lending on a commercial property and the intention is to convert that into residential units, but you can't do that without planning. So the bridge will allow you to sit there, pre-planning bridge, as they call it, get the planning in, and then you'll convert that finance into either a new bridge, which allows you the refurb facility and so on, or maybe a full development scheme, or for you to sell it on with the planning as an uplift. BMV purchases, I've already mentioned them, love them for bridging, they can really come in, and title splitting. So title splitting is one of our little babies. The multi-unit freehold block, as we've mentioned, if you think about it, you've got all these flats in this block that if you was to sell individually would be worth considerably more than the block value as it is, as one freehold title. There are loads of these out there and we're starting to see them. We've got a new product, which I should be speaking about it a little bit, which will allow you to potentially gear up against a split value, even though you're only buying it for the block value, sometimes even below that block value. Up to 100% of the purchase price, sometimes even with cash back on top. Short leases, they're a great way to make a quick buck. There are many short lease properties, particularly in London and the likes, where you want to, if it's only got 20 years left on that leasehold property, you're going to be able to extend that. You can buy it at a much reduced rate. Simple paper exercise, yes, a little bit lengthy, a little bit of negotiation, but once you've got that lease extended, you will make a tidy profit from the difference in between. You can get bridging for that. So look at the metrics. It works a bit differently with bridging. Typically, you're looking at 75% max for a residential property, 70% on a commercial property. It does differ a little bit if you're going to be adding value. There are now products out there which will allow you to go to 80% of the day one value, as long as you are adding value to bring that loan to value down at the end. But if you're looking at standard bridging, you're looking at 75 and 70. Interest is typically retained. Now, what this means is we take the value. Say we've got £1 million property and we're at 75%, 750,000. We work out the interest based on the 750,000 for whatever the term is going to be. If it's 12 months at 1%, then that's 12% of 750,000 and deduct it from there before you get your net loan. And then we also deduct the fees as well. So your net loan is going to be considerably lower because you're paying for that interest up front. Now, if you do redeem within that 12-month period, you will get that rebated. But the thing is, you have to have it there in the first place because you're not going to be making repayments on a bridge loan typically, because usually the situation is the property that you're buying, the reason you can't get a mortgage is because it's empty, it's vacant, something's got to change before you can get that mortgage. There is a difference with refurb loans because now you can get refurb loans where the interest is rolled up on top, but as long as that you're adding significant value to, again, make sure that it doesn't breach typically 75% of the end value, the total loan that you're going to have. Fees and deductions, as we mentioned, rates can vary significantly. If you go back pre-credit crunch, you were talking 2% a month for a bridge loan, and it was never used. Credit crunch happened, and all of a sudden a certain thing called self-declaration disappeared, and people were starting to think, okay, we've actually got to use bridging properly now. We can't just blag what we're earning and do it that way. We've got to use the products in the right situations, and bridging, that's when it started to come up, and a lot more competition came about. And with competition, the rates came tumbling down. However, because there is such a vast different situations that bridging can be used for, some extremely complex, you can go from a very, very simple one, which you can get at pretty much mortgage rates, to something ridiculous, because if it's a complex situation, you've got to start looking at your return on investment and factor it in. Works are usually funded in arrears, much like a development loan. If you've gone through a development loan, you hopefully understand that with refurbs, it's the same. You can get a refurb facility along with your day one loan. This means that if you've got £100,000 of work to be done, but you can't afford to fund those works, well, we can potentially give you 75% day one and a facility of 100,000. However, you're going to only get that in pieces once you've done a certain level of work. So if you've got 4 tranches, so 4 lots of 25,000, you need to do £25,000 worth of work before the lender will give you that 25,000 back to use for the second tranche, and so on until you complete. Homes under the hammer, BRRR, buy, refurbish, rent, refinance. That's what we're all here for. We love a bit of homes under the hammer. That's probably the first port of call where a lot of you sort of started this business. Let's have a look. We'll purchase at 200,000 a property. We'll spend 50,000 on it. It's worth 300,000 at the end of it. Sounds good, doesn't it? Have you factored in your purchase costs? Have you factored in the solicitors, the valuation, the stamp duty? I'm not sure if that's in that 50,000. Wait, finance costs. Have you got the money to do this for cash in hand, or are you going to have finance? The amount of times I see these sorts of things coming to me, but I haven't factored either of these two things in. And you think, well, also you're going to have sales costs at the end of it. You're an estate agent, surely. You're not going to try and sell it yourself. And the contingency. Refurbs can go wrong, and they quite often do, and you will end up spending more. In fact, if you do watch Homes Under the Hammer, nearly every single one of them goes way over budget. And I'm sure many of you have. All of a sudden, that 50,000 is gone very, very quickly, and you haven't earned that much as you thought you were going to. Valuation methods. I'll try and go through this very quickly. There are 3 different ways that surveyors will potentially value your property. There is the comparable method, which looks at the local sales. I'll go through each of these actually separately. There is an investment value, and then there's a residual approach. Comparable, quite simply, let's determine what property type it is, the size of it, the number of beds, rooms it is, figure out the price per square foot, square metre, location, does that have an effect, and so on. The condition of it will obviously have an effect. What the market is doing in that particular area as well, the age of it, is it a new build, is it a Victorian property, these all matter. A 40 square metre, 1-bed flat, average £5,000 per square metre, you've got your value 200,000. These will be based on sales comparables, and that is, they always work off the price per square foot, price per square metre. I've deliberately got this picture here, because it's amazing how somebody goes, all the houses in that road are going for 500,000. Oh, great, okay, yeah. And you're picking this one up for 300,000. Sounds a brilliant deal until you actually go into Street View and you see the house that they're buying is half the size of every other house in that street. I said, how much research have you done on this property? Clearly not enough. It's all about the square footage. You need to know how big your property is. Investment. Comparing apples, here we go. So again, you're looking at the property type, the number of beds and so on. Is it a large HMO when it comes to HMOs? Because the difference between small and large HMOs. Typically speaking, I'll touch on that actually, because To work on an investment valuation, it has to be a large HMO typically. If it's a small one, lenders will typically only look at the bricks and mortar or the previous method, the comparable method for sale. So values of houses that are selling. What's the market rent? So you're not looking at sales comparables anymore, you're looking at what's the rent. And then what you do is you find the expected yield in that area. If you were an investor, what would you expect? Would you expect a return of 6% or would you expect a return of 10%? And then you work backwards. You say, well, you divide the rent by the yield. I'm expecting to, 5% return on a 10,000 rent property. Doesn't sound a lot, but you times that by 20, and then you get your £200,000 investment val. The higher the expected yield, the lower the value of that property. When you get into HMOs, you're typically looking at 10 to 14% on an investment val. When you think about it though, the investment val for a HMO is huge in compared to a residential single unit. The bricks and mortar val is typically much lower than the investment val on a large HMO. The yield that you expect as a bricks and mortar single unit is probably 20-25%. But on investment val, it's 10 to 14, and that brings the actual investment value of the HMO up. Hopefully that makes sense. It is a bit of a reverse complicated thing to think about. There you go, there's an example, £1,500 a month in rent, got a 7% yield, the value comes out at about 250k. Valuation GDV, gross development value, assumption that they are sold individually. So if you've got a row of houses that you're building, you're going to be selling them individually. You're not going to be selling them to one investor, all of those houses. So they will look at the individual sales costs. I mentioned about the net and the gross GDV. Sales periods, again, you have to factor in how long is it going to take you to sell those properties, because your finance is going to keep accruing interest while you're not selling those properties. So you really have to factor in and think about it. And where most of I see problems are in large value single units. And I can only think that's why there are so many of them given away on OMAs, because they haven't been able to sell them. Somebody's built this absolute dream house and you think, oh, this is wonderful, everybody's going to want to buy this. But no, there are so few people that can afford something like that. And if they can afford something like that, they probably want to build it themselves and have their own stamp on it, which is why they can't sell it. Large barn conversions often get caught out with those. You think, oh, it's a dream property, this barn conversion. Really high end, going to get loads of money for it, and you get no bids for it, and you're stuck with it for ages. All the time, that finance is racking up and up and up. Do your research, Rightmove, property filter, of course. Talk to an agent. Just literally pick up the phone to an agent. They're not that scary, are they? No, talk to them. Residual approach. Okay, I know I'm running out of time here. This is where you work backwards. You look at the GDV, and then you work backwards to determine how much that property is worth. And this is always this is where you want to start if you want to figure out whether you're getting a good deal. As that earlier example proved, if you've got a GDV of 300, the first thing you instantly take off is, well, how much profit do you want? If it's a small scale refurb, you still want about 15% of that 300,000 to be profit. You then have to deduct everything. You deduct that 50k cost of works. You deduct any other costs, your purchase costs and so on. Let's call that 20,000. Day one value is 185. Oh, that 200,000 is no longer looking very good, because that's the actual value. If you want a good deal, you're going to need to bid below that after you've worked all of this out. Finance at 75%. And then you've got your thing, so you now have got to start thinking about how much money you've got to work with this deal. Typically, you could be all the way down at 120k, so you can work out what deposit you need from there. You'll need a deposit of 65k plus your first tranche for, as I mentioned, because it'll be in arrears if you want that works budget. If you do have a small budget though, I've mentioned title splitting. These are great for multi-unit freehold blocks. I've put in there ideal if they're 6 to 10 units, but I'm getting some at the minute that are literally 3 or 4 units where there's a decent enough upturn to make it work. It is valued against the split aggregate value. The sum of the parts, as mentioned, is worth more than the whole. That's why you're getting the good, because to sell it as a whole, you can only really sell to investors. If you're selling individually, you've got the world to sell to. 100% funding is available, and this is our exclusive product that we've got at Hilltop. So we can base it on day one as is split value. So even if you've got a little bit of refurb going on, we just need to make sure what's it value now. They need to be saleable as individual units day one. So it doesn't work for HMOs, for example, because they're not saleable individually. They have to be split on their own utilities, ready to sell in their current condition for this to work. What we do is there's an issue with lenders. There are plenty of lenders that will lend against the split value. We've got Castle Trust, Shawbrook, HTB out there, specialist lenders which will lend against the split value of that property, but only as a refinance. Because if it's a purchase, they'll only lend against the purchase price, which is useless. Because all of a sudden the purchase price is what and then they go 75% of that, so you've got to find 25% all of a sudden. However, what we've got is an investor, and we've worked very closely with a lender to make this work. The investor will put that purchase in for you for a fee, of course. The deal will complete with their money, and then it will immediately refinance onto the term product or the second bridge product with one of these lenders that lends against the split value, ignoring the purchase price effectively. You can go straight into the 5-year fixed term. You can sometimes even get cash back out for that particular deal, and we have got a couple on the go at the minute. Come and speak to me if you want to know more about it. But if you do need money to get into it, we've had many talks here. I'm almost done. We've had many people talk about getting investment. If you haven't listened to people who get investment, it is always worth listening to them. But the basics are, you've got to prepare your deal. You've got to show your research. Figures. The amount of time they say that, it's all about the figures. And make it look pretty. They're the basics, and then you can farm it out to investors and try and get that deal in. And as long as you do all of those, you'd be surprised how many investors have got money sitting there and they'll probably just go, yeah, it looks like a decent deal. Yeah, here you go. You'd be surprised. But if you don't do that, they're just going to wonder, who is this trying to get money out of me, quite simply. And that's it. Thank you very much. Hopefully I get
But that was an